got three different pieces, kind of a small, medium, large variety here. The large portion is first, and that's really the legal side of the conversation. The small part, I guess, is in the middle, and that's kind of an investments quick slide conversation. And then the medium part is more of the insurance element, which Julie's going to take care of for us. So I said before, you can advance. As I said before, my name is Paul Tourville. Julie, introduced yourself as well. Our firm Next Level is in Brookfield. Beautiful, somewhat sunny and somewhat warm today, Brookfield, Wisconsin. We've been there for some time, undergoing our fourth expansion now in the 6 years. So that's good. Our agenda here, first off, just kind of a clarification of what is estate planning. I think people get kind of thrown off by that. They see the word estate and like, oh my God, I got to have all this money and I got to have millions of dollars.
Can I just quick interrupt? Did you guys prefer that you speak on something and then they ask questions, or do you want to ask questions along the way or at the end?
Fire away, interrupt, whatever you want to do. I know the material. Don't worry about that.
Okay, so if you guys have questions, just say something and we'll, Paul will stop and Julie will stop and they can ask.
I am kind of a fire hose feeder, so I realize I'm going to have to go back a little bit, but that's okay. So essentially the conversation of what is estate planning, because it is not just for the rich or for the super wealthy or something like that. I tell people all the time, if you care about what happens to you or your stuff, no matter what it would be, you need to do something. Simple as that. We'll have the conversation about wills, which obviously means we have a little bit of conversation on probate. And then of course, the other element, the other road to path down is trust, right? So it's really this will versus trust conversation. What's right for me or right for me? So we'll have that kind of a conversation. Then of course, the conversation about alternative decision makers, and that's really powers of attorney and things like that, which certainly some of you are probably touching already. So with that, estate planning essentially is really kind of putting this puzzle together, right? So it's a plan to manage the money. It's making decisions on who's going to take care of the affairs while you're with us and while you're not with us, right? With all people, myself included. Special situations, if we want to pass assets on, but we don't want to avoid any government assistance or government benefits, how do we protect and make sure those benefits and assistance remain, but the assets are still there for lifestyle and things like that, and obviously making life easier for everyone. So I say easier. It doesn't make it easy, right? I had my mother's first husband, my father passed away. Second husband had a stroke, and thankfully they had done all the legal documents. It was still not an easy process. It was easier, but it wasn't easy. So that's the point here. I think that it's coming upon all of us to put these things in writing. It doesn't make it easy, but it's a necessary step in this process. So estate planning is very holistic in nature. As you kind of said here, it's first off kind of a will versus trust conversation, gifting that can be involved as far as giving assets away, life insurance, probably the easiest tool to use if you're really trying to pass on some wealth in a very efficient manner. And then of course, joint ownership is always just passing on to the next. So conversation about wills and probate, as I said before, a will is essentially a letter to a judge. Dear judge, do this with my stuff, right? Now your trust can be embedded in that will, right? Not a problem. It's called a testamentary, which is a fancy word for post-death trust. But essentially a will is to a judge. Do this with my stuff. You obviously are naming an executor. That's a person that follows the rules of the will. You might be naming a guardian if you've got somebody else that's protecting assets or taking care of people for you, right? Spells out the distribution, and it obviously helps avoid the state involvement. Probate in the state of Wisconsin, the average probate, if anybody's ever done this, realizes this is not exactly a smooth, fast, quick, easy process. The average probate in the state of Wisconsin is 14 months in length. So if you were part of this and you're an overachiever, congratulations, but unfortunately the average is 14 months to get all this stuff passed along. So it is the court procedure, and that's why I say a will is to a letter to a judge. So a will does not avoid probate. It definitely speeds it up, definitely makes it much less expensive, definitely makes it a little privater, but at the end of the day, it is still going to go through the probate process. The probate, go ahead.
So what happens if you don't have a will?
Probate's longer, more expensive, and way more public. I mean, it just is, because you know, the first things first, the state has to reach out and try and find heirs. They have to try and find people, right? And then they have to make decisions. So now you've got a person that probably has never met you being involved in that process. Where is this stuff going to go? Who's responsible for what?
Would you hire an attorney, or does the state take care of all that?
Well, the state will appoint one for you.
And then you have to,
yeah,
the costs come out of your.
I mean, yeah, they say probably on average it's 2 to 4%, you know, so, you know, by the time you get your home value, you get your death benefit of your life insurance, you get any assets that you might have, 2 to 4%. That's very expensive, much more expensive than any attorney is going to be. Even if you go downtown with a beautiful view of Lake Michigan,
right,
it's not going to be that expensive to get your legal documents done. So there is a huge financial benefit in doing it in advance. Plus, you maintain control. You're the one making the decisions versus somebody that you've never met or never even heard of or never seen before. So if you can do anything from a document standpoint, it's not fun stuff. I get it. It's not a Christmas wish list. I understand that. But if you can do anything, it definitely facilitates and speeds the process up and makes it much less expensive. And nowadays, it makes it much more private. If something happened where there's a situation around somebody's passing, an accident or whatever, don't forget the attorneys are going to know all those assets. They're going to want to know all that stuff. And, you know, if it's in the probate process, it is a court record. It is public information. So, you know, a will is basically a way to pass assets on. It can speed up the process dramatically, like I said, but it's still a public process. So the concept here is really kind of about avoiding probate. There's a number of ways to do that. You'll see in the next slide here. We can give it away, right? $15,000 per year to as many people as you want, not a problem. Certainly anybody on this call would sign up for that. Joint ownership, obviously, if you own something jointly with somebody, it's kind of like an uncooked egg. And I know the health nuts on the call will tell me you can separate an egg white and the egg yolk. I get it. Farm kid, I don't separate them. But a joint ownership is kind of like an uncooked egg. You can't really separate it, right? So if you and I own something jointly and I pass away, it automatically goes to you. Simple as that. No probate involved in that. We can have transfer on death or payable on death. That's basically a way of putting a beneficiary on something that doesn't have a beneficiary. So a lot of the things you have will have a beneficiary. Right? Your retirement accounts, your life insurance, they'll have beneficiaries. But your house, your possessions, your clothes, your car, what are you gonna do? Put a bumper sticker on the side of it? Somebody come scrape it off, right? You can't put beneficiaries on those types of things. So most of the financial firms, banks, investment houses and stuff like that have created the term either transfer on death or payable on death. They basically function exactly the same as a beneficiary. The nice part is they're very easy if you change your mind and want to change it, very simple to do, but that's the way in which you pass assets on that don't necessarily have a beneficiary designation. Then obviously you have those assets I mentioned before that do have beneficiary designations like retirement plans and life insurance and things like that. And then the last one, which we're going to transition to now, is the trust conversation. Trusts are a way to eliminate probate. You're not going through the probate process because you're picking an executor of that trust. They are responsible for it. It's not a letter to a judge. It's basically you saying, you handle this for me, and here's the rules, and here's what I want you to do. So they could be the person that's managing assets, or they could be picking people for you to manage those assets. It does avoid probate, so we don't have any of that public stuff, court stuff. The average trust settles in the state of Wisconsin in 21 days compared to 14 months. So it is much faster, and it's obviously.
But that's not free either.
It's not free. It's free from a probate standpoint. You're certainly going to eliminate
Right.
the 2 to 4% cost. If you've got somebody managing the trust and they're managing the money, they're probably going to charge you something to manage the money. It's going to be less than that 2 to 4% for sure.
Okay.
Drafting the documents, you know, that's kind of like a one-time shot for most people. It depends upon whose coffee you want to drink. If you go downtown Milwaukee, you're probably looking in the thousands, and if you're coming out here to the suburbs, and you know, outside of Milwaukee, you're probably looking closer to the single thousand, maybe even a couple $100, something like that. So,
It's worth it.
yeah, absolutely, no question. So trust, I want to make sure that people are aware that they serve a couple different purposes. First and foremost, they're a sword, right? So they help protect people from making bad decisions with money. So the decision I use all the time is, let's use my kids as an example. I have a 17-year-old. I'm not exactly sure he would be making the best decisions if he were to inherit my net worth and my wife's net worth tomorrow at the age of 18. The age of 18 in the state of Wisconsin is the age of majority. So he's a great kid, but I'm not sure he'd be making the best decisions at 18 with that inheritance. So one of the things I can do is I can help protect him in that, listen, I'm protecting you from yourself. So if you need the money for health, maintenance, welfare, education, you can have it. But if you needed to buy the Porsche or travel the world or go find yourself, maybe you wait till you're 25, 30, or 35 years of age, right? We have another situation where you got that daughter or son, you're not so sold on the daughter or son-in-law. Maybe you'll grow to learn and love them and so forth, but right now they're just the new son-in-law and your child is perfect. So you establish little Lisa's trust. You make little Lisa the trustee of her own trust. If something happens to you, the asset, whatever she wants. She can burn it, sell it, eat it, throw it in the street. She can do whatever she wants with the money. She has total control, but she doesn't own it. The trust owns it. Why is that important? If her and the new son-in-law decide to part ways, it's never considered a marital asset. Therefore, it's not part of the divorce proceedings. It all stays in Lisa's name. Lisa can do whatever she wants with it, right? She can buy homes with it, take vacations with it, do whatever she wants. I just tell Lisa, listen, leave the principal and anything you buy with the principal, leave it in the trust. just in case. The other side of the fence is bankruptcy. We've got bankruptcy protection on it then, because she doesn't own it, the trust owns it. And if somebody comes after her to sue her, car accident, right? We got a few of those. You see a few TV commercials, right? It's not her asset. They can't sue her for it. She's the trustee. She does not own it. The trust owns it. So it's protecting. And the same thing in a special needs situation. You put it in there, you don't own it. So therefore, you're not losing access to any of those government benefits and things like that that sometimes qualify based upon financial barriers, right?
What is the requirements for a special needs trust?
It's very similar to any other trust. It's just a special need is kind of the fancy term they put out for marketing purposes. Because a trust by itself, in the big world, there's two types of trusts. Now they get called a lot of things, but it's revocable. I can change it anytime I want, or irrevocable. I can't change it, right? Pretty straightforward. So a revocable trust, you can change, right? You can change your mind, no problem. Just like a will, when you write a will, if you want to change your will, you can change your will, right? Now, we have a fancy word, it's called codicil, but whatever, it's a change, right? You can change your beneficiaries. As long as you're here, you can change them all. It's not a problem whatsoever. It's very simple to do. Irrevocable, that's what it becomes when you're gone. Because when you're gone, it's now irrevocable. That's why it's no longer, it's not Lisa's asset. Lisa, it's a trust in her name. She has total control, can do whatever she wants, but she doesn't own it. That's why it becomes irrevocable. So it's not going to protect you to put your assets in a trust, right? Because you still have total control over it. So it's not going to protect you from bankruptcy. It's not going to protect you from somebody coming after you legally. It's not going to protect you from spending it on crazy, right? Mm-hmm. Because it's still revocable. But when you're gone, then it becomes irrevocable. And that's how it protects people. That's how, then the assets become a lifestyle support. They don't become necessity and needs-based type thing, because we don't invalidate anybody for government assistance or government benefits or government programs because of, well, they inherited $300,000. They've got plenty of money to buy this on their own. No, they didn't. They have a trust, and the trust, they control it, but they don't, that $300,000 is not in their name. That $300,000 is in the trust. So the trusts are really kind of about that shield or sword to help protect us from ourselves and from others, right? In a lot of different purposes. So if your desire is to do anything other than just pass the assets, the plan is pass the assets, the will works wonderful. If the plan is to, either have some strings attached to the assets after you're gone, or put some kind of further protection in place, a trust is the only way to get that done. You do it either while you're alive, referred to as a living trust, right? Revocable still, or you do it after you pass away, which means it's part of your will, which you could change.
I have a question.
Yep.
So say you have all of your assets in a trust,
Yep.
And then you hit somebody with the car.
Yep.
Can they come after your assets in the trust?
Well, again, if you put the assets in the trust, it's still revocable.
If
So
it's,
you
if it's
still
in my
own-
name,
you
it's a
still own,
revocable
right.
trust, they could get those things.
Absolutely, because most people don't even fund their trust until after they pass away.
Okay.
They're there, they sit there, they're a shell, because anything that you put in the trust, unless it's gone, unless it's irrevocable and gifted away. So what asset would you put in the trust that you necessarily give away? What do we see? Well, first off, life insurance policies. There's really only one way to qualify for life insurance policy. It's pretty self-explanatory. You don't really need to own it, right? The other thing I see that go in there, obviously I said before, I was born and raised on a farm, right? 150 years in the family, right? So if it's a family type, legacy type thing, the fishing shanty, the deer hunting land, the farm, the cottage, that kind of stuff goes into irrevocable trust. But regular cash doesn't, because we're still using it. We're still spending it. But it can help out the beneficiary, our spouse, partner, our child, whoever's the beneficiary of these assets, it can help protect them in those situations.
From losing that money.
From losing that money.
Gotcha.
That's exactly correct. And so that's really the big win of it. Whether you choose to do that with an online service, familylawyer.com, legalzoom.com, easylegal.com, whatever, any of those services, the one caveat I would make sure that you're very, very, very careful with is make sure you get the Wisconsin version. There's 50 states in this country, right? There's only 2 of them that are marital property, community property states, Wisconsin and Washington. You have to buy the Wisconsin version. If you buy the Illinois version or you buy a national version, it's not going to work in the state of Wisconsin. Just because Barnes & Noble sells it to you and you bought it at Mayfair, is Barnes & Noble still at Mayfair? Okay, good. Good. Just because you bought it at Barnes & Noble at Mayfair Mall does not mean it's a Wisconsin version. That's a national firm. They sell all kinds of versions there, right? So if you're going to do the online thing, if you're not going to go to an attorney, which is fine, if you're going to do the online, you got to make sure you have the Wisconsin version. It's very clear. I'll say it very clearly all over the package. Make sure you buy the right one. make sure you buy the right one, or you go to the right website when you go to LegalZoom or Family Lawyer or Easy Legal or something like that. Okay.
Any questions yet?
He's going fast.
I know, I'm a fire hose feeder. It's okay. My job is to motivate. The last conversation then is about alternative decision makers. Essentially, this is a situation where you're still here, right? But we need other people to help make decisions in certain situations. Now, that can be as easy as simple as closing on a house, can be as easy as simple as managing assets, right? So we have a very limited power of attorney with our clientele, right? We can buy and sell stuff for them on their behalf. We can't take money out of their account. We can't put money into their account, right, without them, but they let us trade the account internally. That's very normal. A lot of times we buy or sell a house, we'll have a closing agent or a closing attorney have a limited power of attorney to make that closing happen, right? So you've got a financial power of attorney, or you can appoint somebody else to make financial decisions for you, cut the check, pay a bill, whether you're incapacitated, maybe you're traveling, whatever the case would be, that kind of jazz. So there's a financial power of attorney. There's a healthcare power of attorney or a healthcare directive, where you're basically giving somebody else the power to make healthcare decisions for you, right?
If you can't.
If you can't, right. Now, it has to be a trigger event, you know, just give a random person or a friend of yours, hey, whenever you want to pull the, you know, that doesn't work that way, right? You've got to reach that you've got to reach that threshold of incapacitation, right? Third document is that living will. Living will, that's what I said before, it's not really a wish list, but it's real. Where basically you're putting down your thoughts, your wishes, your goals. That might be organ donation, feeding tube, nursing home admittance, pain meds, could be all kinds of things, not fun. But again, if you have wishes, I think it's your responsibility to put them in writing. I just do. It doesn't make it easy for that person you've picked as your healthcare power of attorney, but it makes it easier because they understand your wishes. And then the final document is a disposition document, which essentially is the cremation/funeral document. Those 4 documents you can get right now online. Go to the Department of Health Services, which is dhs.wisconsin.gov. So if you go to dhs.wisconsin.gov, you look on there on the front page, it'll be right in the front, right in the center, most downloaded forms or most recognized forms, and it'll say power of attorney documents. Click print, click print. If you got a spouse or a partner, click print, whatever. It doesn't matter, right? Don't cost you a nickel. They have the governor's seal on them and they work everywhere. Some of these documents are available like at the front desk of a medical facility. The challenge we have now with the whole HIPAA thing and everything else moving forward over the last 10 years is if you go to an Aurora clinic and use the Aurora form, guess what happens when you try and use that form at a non-Aurora clinic?
They won't let you.
We have a problem, right? So that's why I'm saying DHS, Department of Health Services, .wisconsin.gov. If you use that website to get it, it'll cost you a nickel, a little bit in the printer, a little bit of paper. You can do them. 2 non-relatives. Finish your signature. So it doesn't have to be a notary or a signature guarantee. It can just be a flat out sign in front of 2 non-relatives. You're good to go. Keep a copy for yourself. Make a copy for the people that you pick. Simple and
And the
straightforward.
doctor.
Yep. Doctor should have one on file. I think people should put one in every vehicle as well. You know, you get an accident, the first thing that police officers can do is pull out the wallet if it's a major accident, see who you are, right? A lot of people will put a sticker on the back of their license that says, I have a living will. It's in the glove box. So if you have wishes around do not resuscitate or organ donation, things like that, timing is fairly important, right? Most attorneys that you go to, most of the ones we deal with, will give you a little sticker to stick on the back of your driver's license. Kind of looks like a little credit card thing, sticks right on there. I just cheat and use a Post-it note and Scotch tape, but whatever, it works, okay? I'm a cheapskate, that's fine. But having access to those documents. So the concept of putting them in the safe deposit box sounds great. It doesn't work in reality. Unless something happens to you conveniently between the hours of 9 and 3 when your bank is open, it's of little access, right? Putting it in the freezer is of little use because freezers dry out paper. If you want proof of that, come to our office, look in the corners of the conference rooms, you'll see all kind of little shards of paper. That's because when people bring their documents in, we open them up and poof, it's a confetti bomb. Because there's no water in the paper anymore. So don't put them in a freezer, don't put them in a safe deposit box, just have them accessible, right? They're no good unless there's some kind of something that happens to you where you get afflicted. So it doesn't really do any good for anybody to have them. So it's not like, well, I got to keep these in an ultra safe place. You got to keep them in a place where you know where they're at. From an investment standpoint, then we kind of create this.
Yeah, I don't know if I went,
That's fine.
so we did
Healthcare directive, yep. Conservatorship, same thing. We're appointing
And
somebody else.
then, I don't know.
And that's the financial pyramid. Essentially, well, financial pyramid is based upon the concept of needs, wants, and legacy, right? So there's some expenses that you have, food, shelter, light, heat, healthcare types of expenses. We've got a manufacturer income to pay for those things. If you know in your heart, your head, your gut, wherever your confidence comes from, that you're never going to be broke, that you're always going to be able to pay your property tax bill, pay your light bill, pay your food. If you know that in your heart, it's be broke. Well over half America is afraid they're going to be broke. And if you're afraid you're going to be broke, it is tough to take that cruise. It's tough to spoil those grandkids. It is tough to do those things that you want to do to live life. So you have to break apart your assets based upon, first off, make sure the needs are covered. Once the need, that's the play, the travel, the trip, the toys, the spoiling the grandkids, the garden the size of Wyoming, quilts for all the neighbors. That's what that category is, right? Logically, you would front load that in retirement the first 15, 20 years or so. That's when you're doing all the play. Because by the time you're 80, I mean, you've seen the whale 6 times. You want to go 7? The neighbors all have their quilts. I mean, how many jars of pickles do you want in the basement, right? You know, that kind of stuff happens. So as long as my needs are covered, if I lived to 90, 95, 100 years of age, I can front load my play. And then the last top of the pyramid is essentially legacy planning, where I have a desire to pass assets on to the next generation. What's the best way to do that? What assets is that for? And that's really where this whole legal conversation comes in. So that essentially is the large portion and the small portion, which essentially is the legal conversation, wills versus trusts and how they work in the ins and outs. Happy to be a resource. I do understand I'm the fire hose feeder. It also takes care of the small portion, which is the conversation of investments. We have to think once we're retired of what are my assets for? What do I need it for? Do I need it to cover my needs, my food, shelter, light, heat, healthcare? Is it play money, travel, trip, toys, things like that, or is it legacy money? And then, of course, you protect yourself along the way, and that's where I give it to Julie.
So should we pause and see if there's questions and answers, like questions that might,
Are you guys following?
Yes.
Wake up. No, I'm just kidding. Do you have any questions about the parts we just heard? Okay.
okay, then let me go back to share.
Hi,
Okay,
this is Beth and David. We have a question.
Yeah, great.
I inherited some farmland that had been in my family for 3 generations. Our question is, as we look at our estate, whether we should try to sell that land to simplify our estate before it passes on to our children, or is there any benefit for keeping the land, and is there any kind of like skip generation for the taxes?
Right. So the real issue with farmland, depending on how much farmland we're talking about here, but the estate tax threshold is $11.5 million per person. So unless that farmland is in excess of $11.5 million, the real conversation is about the taxable basis of the land, right? So I'm just going to pick numbers out of the sky. Say you inherited the land and the value when you inherited it was $500,000. The land today is worth $800,000 just through appreciation and things like that. Doesn't matter what your relatives bought it for, it's what you inherited. So let's say you inherited it at $500,000, it's now worth $800,000. If you sell that land, you're going to be responsible for capital gains tax on that $300,000 worth of growth. Probably in most situations, 15% tax. It could be 20% federal and another 3% state tax, worst case scenario. So it's not income tax where you're into the 50+% land. It's capital gains tax. So 15 or 20 federal, another 3 from the state of Wisconsin is probably what you're facing. Versus if you pass away and your kids then inherit that land, they will inherit the fair market value as their basis. In other words, their basis in the land will be the $800,000 number I just said. So if they choose to sell it and they sell it for $801,000, they will pay tax on the $1,000. So the fact of you selling it today versus holding it and passing it to the next generation, the whole conversation is about the step up in basis. What was the value when you inherited it? What is the value today? That's the conversation. Unless it's over 11.5 million.
well, and isn't it also, do you need the money today?
Right. Are you hungry? Right.
Do you
Right.
need-
And is there a maintenance cost to it? Obviously, there's property taxes to land. I mean, depends upon where it's at, fair market value. There might be extenuating circumstances. We say, you know what, they want to put, I don't know, Amazon wants to put a distribution hub, or maybe Foxconn wants to put a building not too far from me. And now my land that was worth 800,000 is worth 3 million. Maybe take the 3 million, pay the tax and be happy with it, right? But in a general situation, assuming that that's not happening, that's really about to step up in basis. Does that make sense?
Yes,
Yes.
yeah, and the numbers you chose are just about exactly what our numbers are.
Oh, wow.
Well, thanks
So-
for asking the question I sent you earlier before this session. Sorry.
So my question about that piece is either they're gonna get capital gains on it now,
If they sell
or their kids will when they sell
it,
it.
no, the kids inherit theirs.
At that,
The kids' basis is what the kids inherited at. So let's say grandma and grandpa bought it for $4,
right,
and then it was worth 500 grand.
right,
Grandma and grandpa passed away and you inherited. Your basis is 500 grand.
right,
So the whole $4 to $500,000 is gone.
right.
Now you inherited for 500, it's now worth 800, right? You choose to sell it, you pay tax on the 300. You choose not to sell it, your kids inherited
At the 800,
at the
and then
800.
they can sell it for $1 million, and then
Pay
they would
tax
only
on
get
two.
taxed on the two. Okay.
Right, and I'd like to throw in here, part of the answer to the question that Paul dealt was, and then Kathy brought it up too. Do I need the money from the value of the land today? All right, to meet my needs or living expenses. And the other part of it is, if you keep the farmland, is there somebody in the family that would farm it? Is it still a farm, or would it wind up becoming development property? And if it becomes the development property, then you may want to consult with a real estate attorney about the possibility of putting it into an irrevocable trust, because if you were to exhaust your other assets and the only thing you own is the land, and you go out to sell that land, so you got money to meet your medical needs today, you now are jeopardizing your government programs.
Okay.
One of the issues, am I on here?
Yes.
One of the issues that my brother-in-law had when they had a similar situation was that there were a lot more people involved on the second turn. And it was very difficult to get an agreement about what to do, as opposed to when it first came into the family, there were like 3 or 4 people. Now there's 15. So,
Yeah.
I mean, how much, it's not a monetary factor, obviously, but are you
It's a
familiar?
hassle factor, right? It's a hassle factor. I mean,
Yeah.
it depends on, you got 15 people and you don't have an operating agreement, you gotta go 15 for 15, right? If you
Yeah.
have an operating agreement in place or something like that, right, where you got some kind of a legal document, which would be part of a trust, obviously. Now they inherit, 15 different shares, right? Now I only need 8, right? And
But couldn't the people who own it originally decide who they want it to go to in,
oh, sure, if you want to pick which kid you like, yeah,
wow.
that doesn't happen.
No, I'm just trying to-
And the challenge here is that you can't be equal. It's virtually impossible to be equal. You have to be equitable. You have to be fair about it, right? So to realize that 15 people are all going to get together and sing kumbaya and make one big agreement.
Well, but what I'm saying is, I bet half those people are spouses or children, or, so the parents could specify just their children.
Oh, sure they could. They could
Right.
say
You have 7
not
children and they
you.
all get married. Now you're back to 14 people,
Right,
because we are marital property state.
but you can't put it in a trust so that the spouses wouldn't be able to have any right to it?
Sure you can.
Yes, you
You can do
can.
whatever you want to trust.
Yep.
Whatever you want to trust. Total control.
That-
I mean, you
they
always
might-
on TV. Go ahead.
Those two might not get along very well after that, but
Right.
Yeah,
Right,
Yeah.
but that's the beauty of a trust or a will, is you have your instructions in writing, and the people that you put in charge have to follow those instructions, you know?
And it actually, by doing that stuff in advance, you're obviously saving a few arguments here too. We have a lot of times a situation where there's a business, then there's the building that the business is in, right? So the one son or daughter is going to take over the business, and then we're going to split the building, 75-25, so that we're equitable. It's never going to be exactly equal, but there's the business concern and there's the building concern, right? Well, as
Right.
long as the business rents from the building, You split the rents up however you want. That makes it fair. The business goes to the other one. You don't have to constantly look over your shoulder and ask your brother for help running the business, blah, 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 blah.
One of the issues we have too is that we have kids that are approaching 40 and
Yep.
some that are in high school.
Yep.
And so if you divvy it up evenly at that point, well, the people that are in high school, they've got a lot of catching up to do. They've got cost of college, they have just more expenses. Is there any formula for that, or you just have to kind of wing it?
You're saying as far as give more to a younger child versus an older child?
Yeah, because they're
Not launched.
not launched yet, basically.
Yeah, you would just, I mean, I would just use a financial calculator and assign an interest rate to it, probably 3-4%, and just present value it. So as an example of, if it's $100,000 to a 40-year-old, what is that to us, to an 18-year-old? It's probably going to be $230,000 or so, right? So you just, I mean, if you reach out to me, I can certainly walk you through the math. It's not a problem. So that's usually what we do, is we just assume an interest rate, a normal inflationary interest rate, 2-3-4%, something like that. And just, what is $100,000 in 22 years going to be worth, right? I mean, at 3%, it's nearly double, right? Rule of 72, nearly double. So $100,000 in 22 years is going to be about $200,000. So you give the 18-year-old 200, give the 40-year-old 100, because you're factoring in inflation. So, and I can certainly walk you through the calcs. No problem, easy to do. So
Did that answer
happy to
your
help.
question?
Yes, it did.
Yeah,
Thank you.
Can I just ask who that is who's been asking those questions?
Oh, Beth Johnson and David Smith. Here, I'll turn us on here for a video.
Yeah.
I'm the blurry guy. There we are.
Okay, thank you.
Pretty. Who else has a question?
We'll move on to the next segment.
Okay.
Is that okay?
That's fine by me.
Okay.
Mute us.
Okay, my topic is insurance and what do I need to know versus what do you need to know? The purpose of insurance, okay, when we go through financials with our clients, like Paul went through your needs, he went through your wants, he went through your legacy. And when we start the process, why do you own this insurance? Okay, normally it's to protect what you have, take control of your cash flow, help you invest wisely, because if you have insurance and there's a need to collect on it, your investments can be protected, manage your taxes, save for retirement, or leave a legacy. The different kinds of insurance that we deal with are medical insurance, disability insurance, life, long-term care, property and casualty, which is your home and auto insurance, and liability, which is your personal umbrella in the event you get sued. Being in the situation that you people are in, you pretty much know what your medical insurance is and what it will cover for you and why you have it. The one thing that I thought of when we were putting together this presentation is a lot of people don't understand their medical insurance until they go into a claim. And one of the things that I find is extremely valuable for people is that they look at what their annual open enrollment kit says about their medical insurance, because it's not automatic that what I had this year is next year. And because deductibles change, co-pays change, the cost of your premiums change. And the best way for you to understand your medical insurance before you need it is to go through your open enrollment packet and get whatever summary documents your employer is willing to offer you. You have questions, they have a customer service number. 99.9% of the insurance companies will be more than happy to answer your questions. The next insurance item I look at is disability insurance. Disability insurance is your paycheck insurance, okay? If you're working and you're the primary breadwinner and you bring home a paycheck and now all of a sudden you've been diagnosed with ALS, and I'm listening to these people as to when they got their diagnoses, and I don't believe how rapid some of these people have progressed with this disease. It's like Unbelievable, okay? But you're the primary breadwinner, you get a paycheck every week. Now you're diagnosed with ALS and your mobility and skills begin to taper down. And instead of getting a paycheck, you're now sitting at home and you're running up expenses. And the slide that we have shows the difference between income and debt. Income replacement through disability insurance is like manna from heaven. And most employers, okay, and if you have ALS in your family, this is just my personal feeling. If you have ALS in your family and you have younger children, like somebody said here, he has teenagers and he has 40-year-olds. If you have younger children and they go out into the workforce and they get their enrollment packet from their employers, somebody really should sit down with them if they don't take this responsibility themselves and say, you can buy disability insurance through your employer, through term insurance. The other item is your short-term disability, because there's two types of disability. You have short-term that employers generally offer free of charge, and then you have long-term disability insurance that you can purchase through your employer on a group basis instead of going out into the open marketplace and say, hey, I want to buy this, you know, and you can buy anything, and I'm just going to rate them. You can buy anything from a Rolls Royce to Volt, okay, in the world of disability insurance. And the product could be confusing. If you have a quality financial advisor, you have a quality insurance agent, they have a fiduciary capacity to work through this with you and say, okay, Bill, this is what's going to work best for you. So how do you get this information through your employer? You go out, this slide here shows very well the difference between job A and job B, okay? Job A says you don't get any disability insurance, all right? Job B says, I'm not gonna pay you $60,000 a year. I'm only gonna pay you $59,243 because I'm taking the other $757 and I'm paying for long-term disability insurance. Long-term disability insurance is there for people with ALS, it's there for people with cancer, it's there for people with Parkinson's disease. And when you look at the wage difference that you have, you're paying, excuse me, $14.56 a week to have your paycheck guaranteed should be you become sick or disabled. All right. That's a very, very low cost product. And purchasing it or getting it through your employer is how it's going to be. The drawback to this, ladies and gentlemen, is if you change jobs, you lose what your employer offers. So now you're going through another enrollment packet to find out what that employer offers. If you go out into the private marketplace and say, hey, I need to buy $3,000 worth of disability insurance, that's going to kick in after 9 days. To make sure my gas, electric, my mortgage payment, and our homeowners and car insurance is paid. Okay, that's a private insurance and that's out in the open market. But it's portable. If I work for Rexnord and I have an individual disability policy, then I decide to jump ship and go to work for Johnson Control, my policy moves with me. I'm not going back to first base and trying to differentiate between job A and job B. The next topic we have is life insurance. Life insurance, Paul mentioned earlier, is probably the most efficient, easiest way for people to create legacies for the next generation. And most American people don't understand it. They say, well, my 401k and my IRA and my house, that's all going to go to my kids. Well, you know what? All of that is subject to income taxes in some way, shape, or form. If we have an example going further here, but Prudential years ago, not years ago, maybe 4 or 5 years ago, did a survey and they gave 1,010 people this list of investments and products and said, what's the most important to you? 529 of those people said life insurance. Okay, so it's huge. Do we have to save for retirement? Yes, we no longer get the gold watch and the check in the mailbox every day from Honeywell. Okay. Do we need to have an emergency fund in case the transmission goes out in the car? That's where your savings account comes in. Yes, we need to have those, but each of these items are part of your financial world, and how you rate them is your own business, but this is how the general public looks at it. Life insurance is a financial resource for your loved ones in the event of death. And life insurance policy, most of us already know what it is. It's a contract, all right? I go to, say, John Hancock, and I say, I just bought a house. I got a $300,000 mortgage. I got a 7-year-old. I got a 10-year-old. I get hit by a bus. I want my wife and kids to stay in the house. How much life insurance do I need? Well, you got $300,000 mortgage, so you would need $300,000 worth of life insurance, unless you want to use your savings or your 401k plan for your family. Those are not the most tax efficient ways. And when you're dealing in financial planning, one of the, in addition to the legal aspects that Paul discussed earlier, the next biggest issue that I deal with is income taxes. Okay, if I can get $100,000 income tax free, that's probably tantamount to mom and dad being in a 20% tax bracket and inheriting about a $280,000 IRA. Huge difference. Okay, so the insurance company says, okay, you pay me $10 a month. If you get hit by a bus, I'll deliver a check for $300,000 to your wife. That's basically the way it works. Now, if your mortgage is paid off in 30 years, do you need that life insurance forever? Probably not. So in a case like that, you would look at something that's called term insurance. All right, next slide. Term insurance is you're renting it. You don't own it. So if you own your home, you build equity. A whole life insurance policy, you own that, you build equity. If you don't want to build equity, you rent your insurance. In the last 20, maybe 25 years, life insurance industry has done a complete 360-degree turn with the products that are available. You can still buy term insurance. You can still buy a life paid up at 65 policy. But now we have universal life, in which specific interest rate is assigned to the contract every year, and it's revisited every year. And the cash value that builds up inside of a universal life policy is paid that interest rate. Variable life insurance works kind of the same way, only instead of giving you a guaranteed account like a CD that the universal life contract represents, we let you invest in mutual funds inside that life insurance contract. So if you make profits, excuse me, then those profits are not taxed as long as you keep paying, and it doesn't fall by the wayside. If you were to cash the policy in, you may have income tax consequences. Do you want to take insurance into retirement? I would venture to say that many of the people that we went around the table today would really hope they had more life insurance than what they have. And those who chose not to carry insurance into retirement that are past age 65, excuse me, and are diagnosed, no longer have the option of buying life insurance. So,
Once you get a terminal diagnosis, you're not allowed.
right, you're not, no insurance, life insurance, health insurance, the only way it would be is under Obamacare. Okay, so insurance is age rated, it's health rated. Like Paul has on one of our slides going forward, buy insurance, don't buy it with the intention of paying it for 5 or 6 or 7 years. If you buy term insurance to cover a 30-year mortgage, your expectation is to pay that premium for 30 years. When the 30 years are up, the policy falls by the wayside. You get nothing back except a pile of receipts from the insurance company. Just like if you rent an apartment, you got a 30-year lease. At the end of 30 years, he sells the building, you move, you have no equity, but you got a pile of rent receipts. That's the difference between permanent insurance, what we call whole life, and term insurance. Before you buy any policy, you're going to ask yourself some very important questions. The first one is, how much do I need? I talked to you about a mortgage and protecting your home for your family. You have children, your wife's going to have to replace your paycheck because Social Security certainly isn't going to support your wife and children, not in the lifestyle you created for them. So you have to look at how much insurance do I need. A quality financial advisor can sit down, and even if you do it on a legal pad, you could do it yourself. Okay, here's what I owe. I want to pay for Jane or Lisa's college. Okay, it's going to cost me to go to UW Madison, or you do UW Bucket. It's going to cost at least $100,000 for Lisa. It's probably going to cost maybe $200,000 for Joe because he's not going to go to UW. He's probably going to go out of state to school. The question you have to ask yourself is, do I want to create the capital for that in case I get hit by a bus? If the answer is no, then you wouldn't include that in the amount of insurance you purchase. If the answer is yes, you want to give them a little bit of help, but you don't want to be, pay for the full ride, let them have some skin in the game, then you're going to say, okay, I need an extra 50 for Lisa, I need an extra 100 for Joe. So that would add to the amount of life insurance that you need. Next question, is the insurance company I'm considering financially stable? Okay. Back in the 90s, we had a number of insurance companies in the United States that got in huge trouble, and some of them were big names. So what happened within the industry that became more publicized is we have certain firms, and you can see it on your slide, AM Best, Flitcraft, Standard & Poor's, Phelps, and so forth. These are the consumer report guides for insurance companies. Okay, so if you're thinking of buying insurance from Outdoor Life, you might want to go online and look and see how Moody's has rated them. If you're thinking of buying insurance from the bigger carriers, you got your Prudentials, your Metropolitans, your John Hancock, your New York Life, those firms are reputable. They've been around almost forever. And the bottom line is they still get a report card from these agencies. So it's not going to hurt you to go out online and look up these agencies and have them give you their Cliff Notes version of whether or not you're buying insurance from a quality company. Okay. Our next thing, how can you conserve costs? The difference between term insurance and permanent insurance for somebody 40 years old is this one would probably cost, and I'm talking like maybe a $500,000 policy. This would cost you probably about $150 a year, because at the end of the term, you've got nothing. But this one over here would probably cost you about $500 a year if you're in good health, because it's building cash value for you. It could be a source of an emergency fund. And the one thing that I have found in my years of financial planning is people who happen to amass significant 401k plans or significant IRA plans that want to leave this to their spouse or want to leave this to their children because they really don't need it. They only take out what the government forces them to take out. If I have a $250,000 IRA that I want to leave to my daughter, and she's in a 25% tax bracket, and I have a $100,000 life insurance policy, my daughter would have the choice of taking that $250,000, paying the income taxes at that point in time with the $100,000 life insurance, and now she has $250,000 tax-free account. That's another option for people who go into retirement owning permanent life insurance. It helps fund your legacy. Don't buy more insurance than what you need. We talked about a quality person sitting down with you, or like I said, you can even do it yourself with a legal pad. Shop for competitively priced policy. Insurance rates have changed drastically in the last 40 years because you look at life expectancy, the average life expectancy for a person 65 today is 83 for a male and it's 88 for a female. When my grandfather retired back in 1960, what's the matter?
That's so old. I don't.
When my grandfather retired back in 1960, he was 65 years old and his life expectancy was 73. Okay. Today, in the world of financial planning, it is not rare for somebody to say, well, my money needs to last till I'm 90. My mom's still alive and she's 92, you know, and if you're in good health, like it says here, don't smoke, okay, take care of yourself by exercising regularly and maintaining a moderate rate. Those are two very big pluses that will allow you to get cheaper insurance in the open marketplace than a smoker or somebody who's overweight. Okay, so personal health is very important. And like disability insurance, life insurance is age rated, it is gender rated, it is health rated. Okay. Families, young families. Okay. I realize that we're dealing mostly here with the people on our call today who are, you know, not raising 7-year-olds or 10-year-olds.
No, there are people.
Are there?
Yes.
Okay.
Mhm.
You can buy a policy on yourself and you can put a rider on it for your spouse and you can put a rider on it for your children. Most insurance companies allow this to happen so that you have one policy with one monthly premium coming out of your checking account. Okay, so riders are very important. There's different kinds in the marketplace, so if you choose to go that route, you definitely should have your advisor investigate it with you. And shop around, very competitive. Are very competitive today, and life expectancy has brought premiums. Life expectancy extension, okay, has brought premiums down significantly. When I first started in the industry, we used the commissioner's 1962 mortality table. Today, we have a mortality table, I think it's 2016. Okay, so mortality, that's what actuaries do, you guys. The other way that you can get good, cheap life insurance is through your employer. Okay, most employers will say, okay, Julie, you work for me, you make 50,000. Well, take the example of our $60,000 a year salary. I will give you as a company benefit at no cost to you 1 times your annual salary. Okay, but the company that offers us or takes care of that for us says you can come through and you can buy up to 5 times your annual salary, and we take it right out of your paycheck, right out of your paycheck. Okay. As you age, it gets a little bit more expensive. If you terminate employment, you're back to the same square that you were with your disability insurance. All right. But it's better than nothing, and it's cheap.
A lot of times it's not even underwritten. So
Right.
it's
You
gonna
get
be
like
huge
3
plus.
questions. In the last 5 years, have you been diagnosed with cancer, had a heart attack, or been exposed to AIDS? I mean, they don't even go into Parkinson's, ALS, and stuff like that. Okay. And if you have a debilitating disease like ALS or Parkinson's or cystic fibrosis, MS, whatever, in your family or extended family, okay, the chances of you coming up with are probably slim, but that chance exists. This is when employer insurance is very, very valuable. And if you buy the insurance through your employer and you become disabled and you lose your job because of that, 90% of those companies will allow you to convert that $300,000 group policy to an individual policy. Yes, the premiums will go up, okay? Yes, it may build cash value because you can't convert term to term, but it's better than nothing, because if you become disabled, you're not able to buy insurance in the open marketplace. Okay. Next, married couple. Okay, this is where I said that.
It's your fancy legal pad.
Yeah, it is my fancy legal pad. Our big analysis for you. This is basically what you have to do. Okay, you look at what your paycheck is, where it brings your family and its standard of living. How much they're going to need if you're out of the picture, and subtract mom's salary. And that's how much you're short on an annual basis to allow your company or your family to stay in their home, to go to college, okay, private school, whatever it is, get it, not be driving a beater and running safety risks. Okay. Do you need $90,000 because your child is 7? You want to insure yourself until they're what, 20, probably, get them 1 or 2 years in college. All right. So you need 13 years of income replacement. That comes out to almost $1.2 million, but you really don't need $1.2 million, because earlier Paul alluded to the rule of 72, where if I put $500,000 in the bank and I can make 3% on it a year, I'm automatically giving mom $15,000 a year that my paycheck is providing. So it's not an enormous off the wall number. There's ways to manage it, and a business calculator and your legal pad would help you do that. Long-term care insurance, okay, that is a product that came on the market back in the early 80s. Before that, we had who is that guy from Wild Kingdom? Mutual of
Omaha, Merlin Olson.
Yeah.
Merlin
Yep.
Perkins.
Merlin Perkins. He sold cancer policies in the 60s and 70s on Mutual of Omaha. Remember that?
Mm-hmm.
And
I do.
what would happen?
I was
is-
really young though.
A great memory for a 6-year-old.
What would happen is people, would buy cancer policies and they wind up dying of a heart attack and never collected a dime. So the insurance industry developed what we call long-term care insurance, okay? And it really came to surface when dementia and Alzheimer's wound up being big social issues. And long-term care insurance is again, it's age rated, it's gender rated, it's health rated. Okay, so if you're in good health, the younger you are, the cheaper it is. But I have multiple clients who are collecting under long-term care insurance because of a swimming accident and they're now paralyzed from the neck down. Okay, it supplements your medical insurance.
Well, we, talk about long-term healthcare insurance for people that have ALS,
Yeah.
because they're gonna need all that extra care. And I would say probably 1 out of 50 have
Might own
invested
it.
in it. It's not cheap, I don't believe.
No, it's not.
Yeah.
I'll tell you, I
No.
bought one
Not at all.
and on myself, and my premium started out at $180 and it's now up to $484. Not because I've used it, not because I put in claims,
Because you're getting older.
because A, I'm getting older, and B, the actuaries mispriced the product in the 80s and 90s because they anticipated so many people would let it fall by the wayside. People who own long-term care insurance do not give it up.
No, you put all that money into it.
Exactly.
Yeah.
Well, there's a way to protect what you put into it, okay? But every year my premium goes up exactly what you said. My secretary says, what do I do? I says, you're a year older, you're closer to using it, keep it, you know?
Yeah.
So, but long-term care insurance is a godsend. If you own it and you're diagnosed with ALS, the insurance is a godsend. Because it can help pay for care in your home, okay? It can help pay for your care in a skilled facility, okay? Most of the policies today will even put if your caregiver is your spouse, they will put that spouse in a 24-hour training class so that if I have to quit my job to take care of Paul, okay, I now can get reimbursed for all the hours of care I give Paul,
Mhm.
okay? It's a godsend.
But you have to read the fine print in those things, because there are different hoops to jump through.
There are,
And-
okay,
And the
there
industry's
are.
really responded. I mean, for years and years and years, they sold them as standalone products, right? So there's really only 3 things that can happen in this situation. You can live a long, healthy life and at some point go on claim, right? You could pass away and having used none of it or very little of it, right? Or you can just change your mind and say, I don't want to pay for this anymore. So it's the old kind of conversation of live, quit, and die, right? Well, originally, when this stuff came out and it was being sold, it really was great if you went on claim, right? But the problem is if you passed away, you spent a lot of money on it, probably thousands of dollars per year, and you never saw anything for it, right? And people seem okay with that when it comes to auto insurance, but but with long-term care insurance, it's painful, right? I'm spending $4,000, $5,000, $6,000 a year. I did it for 20 years. I spent $100,000. I passed away. I never used it. $100,000 gone, right? Or if I change my mind, I don't want to do this anymore. The money's just gone.
It's a gamble. It's a gamble.
So
Insurance is-
the industry has responded. About 7 or 8 years ago, they started to kind of release all these hybrid products. So there's 2 basic chassis of hybrid products. One is built off a life insurance chassis. So if it's built off a life insurance chassis, go 3 scenarios: live, quit, die, right? So if you pass away, a life insurance has a death benefit, right? So if you use that $5,000 annual premium example, 20 years in, you paid for it for 20 years, you put $100,000 in, probably a death benefit about $125,000. Okay, paid tax-free, 7 days. So at least the spouse or partner or kids are fully reimbursed for everything you spent on it. You quit and say, I want out. A lot of these contracts are sold with 100% premium return guaranteed, kind of off the rack, 70, 80%. So if you put $100,000 in, you say, I'm done, I quit, they're going to mail you a check back for 70,
Oh,
80
really?
grand.
Oh, I didn't know that.
Third scenario, you go on claim. Now you're probably looking at a 2.5 times multiple. So now you're probably looking at a $250,000 bucket for that 100,000 that you put in. Those contracts, because they're life insurance chassis built, deal with guaranteed prices. So you don't have to worry about Julie's example about the price going up. They can't change the price. Non-cancelable, they're guaranteed continuable. They're typically paid annually, or on a regular basis, whether it's monthly, quarterly, semi-annually, but they're typically paid on a regular basis. You're putting in X dollars and you're doing that for the foreseeable future. The other chassis that these things are built off is an annuity chassis. These are typically funded with a lump of cash. So these are people that typically have the money sitting over here in the bank. It's kind of their long-term care fund. It might be earning a couple % in a CD. I hope I never need it, but if I need it, I got that $100,000 sitting there. Well, you transfer it to one of these products, right? 3 scenarios. Pass away. What goes to your beneficiaries? The $100,000 plus whatever interest you earn, right? You quit. You say, I don't want to do this anymore. What goes to yourself? The $100,000 plus whatever interest you earn, right? You go on claim, you're probably looking at, again, a 2.5 times multiple, 3 times multiple. You're probably looking at that 100, providing you $250,000 to $300,000 of benefit. What's the rub? The interest rate's less. So if you're earning maybe 2-3% in that CD, maybe these pay 0.5% to 1%, you're earning a little bit less interest, but you don't have any of your principal at risk. Clearly, from an underwriting standpoint, it is a much lower barrier to cross because you're funding them typically in a lump sum. You're putting in my example, put $100,000 in. $100,000 is not at risk. You're gonna get it back if you change your mind. You're gonna get it back if you pass away, or if you go on claim, you're gonna get a multiple of it back. But because you put $100,000 with the insurance company, the underwriting to get the product is much, much easier to cross that threshold. So we don't have as much medical underwriting to deal with. That's kind of where the industry has gone from a long-term care perspective, is more towards either the life insurance chassis or the long-term care chassis. So in a nutshell, that's kind of the small, medium, large conversation about lots of things. I understand kind of fire hose feeding today. I get that. But whatever it is from your standpoint, happy to sit here and answer any questions you might have as long as you want. That's not a challenge. Also, our contact information is available. Happy to be a resource for you, as I said before, whether that's today, next week, next month, whatever it is. We're happy to be that resource for you and answer those questions. Fill in a little bit more, speak a little slower, use a better example, whatever the case would be, we're happy to do that.
So there is a question in the chat
Great.
about how important it is, or do you need to get insurance before you become disabled?
Well, absolutely, because there's no way in the world an insurance company is going to issue a policy if you're already disabled, right? Now, if for disability insurance, if it was life insurance, that's not necessarily the case. It depends upon what the reason for the disability is, right? So in Julie's example, was a swimmer, if they got hurt, that probably is not going to preclude you from getting life insurance. But if you are disabled because of ALS or something like that, that probably is going to exclude you from getting life insurance. So what you're really talking about is maybe the next generation. There's also some guaranteed issue contracts out there, right? So we deal with a couple of companies that are like, they get the branding of funeral trust or something like that, where you buy, $10,000, $20,000, $30,000 of coverage. You can certainly do that without any medical underwriting. So there are options out there to get smaller amounts of life insurance without doing medical underwriting. And the medical underwriting world is dramatically different. You used to have to take an exam every time you bought life insurance. And now, unless you're buying more than $1 million, you're probably not having to take it. You're probably just pulling medical records. Great question. Thank you.
I have a question that comes up quite a bit. As far as the spending down, if you want to be on Medicaid, I think people have a lot of questions about that process.
Julie Douglas will answer that question for you.
Well, the state of Wisconsin is constantly updating the rules and regulations for that. And they're becoming a little bit more understanding, and the spend down is still part of the formula. The disabled person or the person that you would require Medicaid for is also limited to the $2,000. If this person is joint owner of a home, the home is protected. If the spouse or an adult child is living with them and contributing towards the cost of the house, they won't come after your home, and it will not have an estate lien put on it. But it's a formula, and you really need to sit down and you need to have a listing of your assets that are absolutely in your name. Then you need to have a list of the assets that you own jointly with your spouse or whomever. And then you need to have a listing of what your spouse's assets are. But the Medicaid now looks at the patient's assets with greater weight than the community household assets between husband and wife. All right. So there are a way. Paul alluded earlier with gifting and whatnot. Yes, there's a 60-month look back period, but depending upon the number at the bottom of your balance sheet, there are ways to gift these assets, transfer certain assets to a irrevocable trust. All right. Because then your family can benefit from that asset, but it's not counted on your income statement for Title 19 purposes. But there's not a simple
Way to do it.
No, there is not a simple way.
But
do
it can be done.
It can be done.
Absolutely.
Absolutely. We do it all the time.
Okay.
Absolutely.
Interesting.
It's just a process.
Yep. And you have to know the rules and regulations.
And all the formulas.
Yeah.
How you
I
guys doing?
apologize. I just joined in late, but Mary, thank you. That was like perfect timing for a question I currently have.
Oh, good.
Expanding on that, we've been working on a lot of that stuff with our financial planners, and they start putting in our estate plans and that for myself and my wife. Recently, her mother passed, so her dad is still surviving, and he's got liquidating some of his, like the life insurance money, dividing that among the kids, etc. So there's lump sums of money that will be coming in. So my question is, like, can my wife do with that so it ain't adding into what we already have as assets for me or financial? If one thought is she puts in an IRA for herself, that's her retirement, it's kind of not touchable or whatever. But what if she started opening up her own individual bank account? Is that enough separation where it's hers? Her dad wrote her a check just to her, and is that enough separation? Or
Yeah, that's always the first step, right? So she should not put anything into a joint account with you. It should all be individually titled in her name. Any dollar, any person in the world, affliction or not, right? If myself and my bride Kelly, if Kelly inherits money from her parents, if she keeps it in her name, it's not considered a marital asset anymore because it's in her name, right? If she decides to then use money from that to pay for joint things, that's a different story. That money that comes out is now obviously a joint asset, right? But if she keeps it in her name, it's still separate. Okay, so that would certainly be suggestion number one. Yes, if she doesn't have her own bank account, she needs to get her own bank account in her own name, right?
Even in the state of Wisconsin, where it's a community property state.
Inheritance is protected as long as you don't pierce the veil, is the phrase the attorneys like to say, right? So as an example, let's say that my wife inherits $100,000. It goes into her name, but then she takes the $100,000 and makes a mortgage payment in a house we own jointly. Pierce the veil.
So then she's out of luck.
So that $100,000 is now considered a community asset, right? But say she has $100,000 and she decides that she's going to take money from that $100,000 and pay for a trip. Doesn't matter who goes on the trip, right? It's not a tangible item. It's safe. It's safe. She uses the money out of that $100,000 to pay for regular expenses that are not jointly held assets. It's still separate. It's still protected. If my daughter inherits it, we want to keep it away from the son-in-law, right? As long as she keeps it in her name, as long as she doesn't use it to pay for expenses or to pay debt on a joint asset, it's safe. If she does use it for those types of things, it's called piercing the veil, and therefore that asset, even though it's still titled in her name, is includable. To your point, community
So the
property.
whole amount then,
The
or
whole
just what
amount,
she
the whole amount,
spent?
the whole amount. So if you took, if you're the caller, if you're the online person, if your wife inherits $100,000, puts it in her bank account and an account in her name, she has total ownership, but then takes money out of that to pay a mortgage payment on a property owned jointly.
Then the whole 100,000 is open.
Correct.
To both.
So then if we want to do that, what do? We retitle the house to the wife's name, right? Which is a quick claim deed. It's like one piece of paper, 30 words. It's not a very complicated document, right? We retitle the house out of joint ownership into individual ownership, and then she can pay those bills because she's paying it with an asset that she owns entirely.
And then that home that's just in her name now,
Out.
he's got no, even though he's been paying on this mortgage along with her for
Because
the last.
he gave it away. Now you got the same 60 month rule, right?
Oh, there is.
Yeah.
So you got the same,
Okay.
because
Yeah.
any asset you want to get rid of, there's still a 60-month look back, right? It's 5-year.
Can you explain that just more concretely? I
You
understand.
can't give stuff away on the way in the door, right? I mean, so the state of Wisconsin, pretty much every state in this country now uses a 5-year look back. So if you tried to give assets away purely for the purpose of avoiding paying the nursing home, because you wanted to go on Title 19 as an example, they're going to look back and say, okay, what did you give away in the last 5 years?
But you can by law give away, like to each, like you said, each child, you can give 15,000. Is that included in the look back?
Yes.
Yep.
Okay.
Now, there's probably not going to be a lot of records on it if it's under 15, right? Because under 15, nobody has to file a gift tax return. Nobody has to file any form.
But that's the most you can give someone, correct?
That's the most you can give someone without filling out paperwork.
Per
It's
year.
Per year, per person. But the estate tax threshold is the same as the gift tax threshold, $11.5 million. So if I've got a $3 million chunk of property and I want to give it to you or anybody else at this table, I can do that. I'll pay no tax, you'll pay no tax, but I've got to fill out a 706 gift tax return. Now there's documentation. Now there's paperwork. Now you're clearly going to have a 60-month look back. But if I just scratch you a check for 15 grand, I don't fill any paperwork out. You don't fill any paperwork out, right?
Well, plus that's legal.
Well, I'm saying it's all legal. I'm saying that 15 grand is the max per year to give away without paperwork.
Got it.
Paperwork creates a trail. Trails show up in 60 months looks, right?
So if you give your son $15,000 in January and then give him another $15,000 in June,
Technically, that's not legal, but I would have, unless I filled out a gift tax return.
because he's gonna have to explain where that money came from.
Well, theoretically, I mean,
Okay.
right? The correct way to do it would be if it's over 15 grand to fill out a gift tax return. 706, it's a one-page tax return. There's no tax due by me, no tax due by the son, nothing, right? But that's technically the way to do it if it's over $15,000.
Right over the other one.
Did that answer the question? Is
Right.
that Steve?
Yes, Steve.
Try to keep the assets separate as much as possible. If you're gonna use the money to pay for joint owned property, that per joint owned property should be single owned property before you do that. So you're gonna try and
Got
get
it.
it all in your spouse name. Any joint property going to single ownership is gonna have a 5-year look back. So I always tell people, the first 6 months or a year that you're diagnosed with something, it's focused on getting healthy, right? Is this reality? Can I change the situation or can't I change the situation? If I can't change the situation, then the plan becomes, okay, who do I talk to protect as much of my stuff as I can, right?
Right,
And that's basically that 5-year window.
right.
That,
And-
that's exactly where we're at, and that did answer my question. Piercing the veil was a very critical piece of that
Yep.
that I needed to know. Thank you.
Absolutely. You bet.
Eric, I have a question.
Yeah,
I'm going back to long-term care policies and the elimination period.
yeah.
When did that come into being?
Oh, elimination periods have been around since day one. The reality situation is most of them, they tie this to Medicare. So Medicare, if you have a 3-day hospital stay, now 3 days in a hospital stay today is
Long.
pretty serious stuff,
Yeah,
right?
yeah.
So the 23.5 hour not admitted person, right? That's not where we're talking about 3 days. But if you have a 3-day hospital stay, Medicare will cover your long-term care expenses 100% for the first 20 days. And they'll cover everything over their deductible, which is like 170 some
80,
dollars
it's
a
up
day.
to 180 this year.
180. So you pay the first 180, they pay everything on top of the 180 from the 21st day to the 100th day. After 100 days, Medicare is out. They pay nothing. So a lot of these contracts were sold with either 20-day or 100-day elimination periods, right?
Mhm.
Hancock and NML use that 90-day, which is kind of quirky, but whatever. It is what it is. However, if you don't have the 3-day hospital stay, Medicare pays nothing.
It's
Right?
all a gamble.
Yeah, well, it's not really a gamble. It's educated, but at the end of the day, it's like all insurance, right? When you look at car insurance, do you carry deductible on your car insurance?
Yes.
Probably the answer is yes, right? What size deductible do you carry, right? Because that has a dramatic effect on the price that you pay. Carrying a $0 deductible is going to be more expensive than carrying a $1,000 deductible. So you have to make a decision on what's the right fit for you. Same thing with medical coverage. When you understand that 85% of claims are less than $2,500, if I carry a $1,000 deductible, that's going to be substantially more expensive for me because I bring that 85% into what the insurance company's got to pay. But if I put that deductible at $3,000, it's going to dramatically reduce my price because I've eliminated 80+% of the claims, right? In all forms of insurance, it is logical to assume there will be a deductible. How heavy that deductible is or light that deductible is really is a personal situation, right? So, do you sit here and say, you know what, I want a $0 deductible so the insurance company pays it day one? No problem. That is clearly going to be more expensive than if you use a 100-day deductible. It just is. It's just the fact. And quite honestly, with long-term care, I care about the big game. I carry about 5 years from now, 10 years from now, are they still writing me checks? I'm not so concerned about the first 100 days.
Right.
Because if I go on long-term care, my father went on long-term care twice in his life. Once because he had to have a valve, originally thought replaced, it became repaired, right? So he was, on long-term care services. We had to have a at-home nurse take care of him for that period while he was recovering from that. But he recovered and went back off. And then he had a cataract surgery, right? Adult LASIK, as we like to call it now, right? And was on Flomax. So I got a detached retina because Flomax, obviously you see the commercials now, all that kind of jazz, right? So, legally blind for a period of time until he got his eyesight back, right? So he went on claim twice, but recovered. That's pretty rare. Most people, when they go on long-term care, they're on. So don't get hung up. I don't think it's financially worthwhile to get hung up on a 0-day deductible or 20-day deductible, because it's really about, are they gonna write checks for 5 years? That's really what I care about. But no, deductibles have been around since day one, especially on the long-term care payment side. The biggest thing is that people don't claim until it gets serious. And I always tell people, go back when the first time you had somebody come in, maybe only coming in 1 time a week or 2 times a week. That's when the claim started. It didn't start when you need somebody 5 days or 7 days a week. It started when they were there 1 day a week, right? So as soon as somebody goes on some type of care, a day a week, you got to get the note in the file, because they're going to pull the medical records, right? And if that note is in the medical file that in April they started using a person 1 day a week, that's when your elimination period starts, is April. If you don't tell anybody and it's August and now you need it for 5 days a week and you say, I'm going to go on claim, your start date is August. You lost all
That
those
makes
months.
sense.
Right.
It's just like when you quit smoking, get it in your medical file, call your doctor, have them put it in the medical file, because that's what most of these places, these insurance companies, all they're doing is pulling medical files. They're not gonna take your word for it, right?
No.
They're gonna pull a medical file. So as soon as something happens where you go on any type of claim, even, it's only a couple hours a week, so what? Now, a maid doesn't count, by the way, but I'm just saying. If you go
Well,
on any
the
type of,
housekeeping services do count to the
Well,
extent if you.
Can't do it
few
yourself.
of the activities of daily living.
Right.
And.
but your
you know,
doctor has to sign
right.
off on it. So I'm just saying, just get it in the medical file. That'll start the clock ticking.
And like you said earlier, Mary, you've got to read the fine print in your long-term care contract, because some companies, your elimination period is 90 days of services. So if we've got somebody like Paul, who's got somebody coming in only 1 day a week, okay,
So
it's
it's
going to
90
be
weeks.
2 years before you'll be able to collect,
Exactly,
you know?
exactly.
Yeah,
Right, versus calendar days.
Or they have certain agencies that you don't know, you should have gone with company A, B, or C, but you picked D, so we can't use that as a starting point either.
right. But most of the long-term care carriers today have an agency that kind of signs you as like a quote social worker
Mhm.
who helps get you assessed, okay, confirms your medical records, refers you to Bright Star or Home, whatever these
Right.
agencies are. And for the first 2 weeks, just make sure that everything is set up properly. And that is part of your long-term care coverage.
For the service.
Yeah.
Good question. Anybody else?
I got a question.
Yep.
Go ahead.
Yes, I got a small business since 2006, and I got a rental property. My question is, my doctor asked me that I can apply for disability. I haven't done it yet because I still able to. I'm not able to work on the shop, but I talk to them on the phone, trying to do some work. But when the time comes close, do I need to sell my business? Do I need to sell my rental property in order to get disability?
No. So first things first, you should file immediately, because again, it's about starting the clock. So whether you're gonna go on claim or not, it doesn't matter. You want something in the medical file that says something is happening that, maybe I'm not totally eliminated from work right now or not, but I want something in the file, again, because of the elimination period conversation we just had. But disability policies, it comes down to your definition of disability, right? So it doesn't matter that you have rental properties and stuff like that. It comes down to your definition of disability. There's 3 different definitions of disability. One definition of disability is your present job and all the requirements of your present job. Can you do that job? The second definition of disability is, can you do a job that you're trained for based upon your education experience? So that's not your job presently. That's a job that you're reasonably trained for based on education experience. The third definition of disability, which is the Social Security definition of disability, is any job. Can you do any job? So needless to say, the threshold to get over those are dramatically different between those 3. So when you look at your individual disability policy, it probably is going to be a job that you're trained for based upon education experience or your own occupation. That's the standard that they use to determine whether or not you are claim eligible or not. Social Security definition, any occupation, challenging. Although, yes, we do have 70+ million people on Social Security disability, but the reality of the situation is that the threshold to get on Social Security disability is much easier, or excuse me, much harder, much harder to get on Social Security disability than it is regular individual. So I would look at your contract definition of disability. It's probably paragraph 1 in your contract, maybe 2, other than the name of the company you have it with, and look at that, because that will tell you whether or not you're going claim or not.
Okay, sure.
Did that answer your question?
Yes.
Have you applied for Social Security disability yet?
No, I haven't, because I was thinking, that I got my own shop, my own business and my rental property. I was thinking, that I probably not apply for disability yet.
Is your rental property filing as a separate company, a schedule, corporation Schedule C? In other words, does it file its own tax return, or do you run it through your tax return?
I run it through my tax return.
Exactly. So it's a passive, right? So it's a passive investment. I'm sure you feel like it's a business. I get that. But in the eyes of the IRS, it's a passive investment, although you probably don't feel that passive from time to time. So that's not a part of a definition of disability. Again, I would apply immediately for Social Security, even if you don't think you're going to get a yes out of them, because the elimination period of Social Security is 12 months. You have to start the clock ticking. So even if you submit it now and they say, you're not quite there yet, you're not disabled enough in our eyes, I guess, terrible as that sounds, at least you've set the starting point. At least you've set the starting point.
Medicare.
Okay, I will then. Thank you.
Mary, didn't they recently in the last year or two change the requirement to be much shorter for ALS patients
Yeah.
to be
Well,
like
it's-
5
Yeah.
months?
It's 1 month.
Yeah.
That's for Medicare. That's for Medicare.
Yeah.
No, it's for Social Security disability, okay? It used to be that you had to be out of work for at least 5 months before you could even apply for
right.
Social Security
Now,
disability.
someone with ALS,
And your disability was expected to last at least 12 months, but they just came out with, there's 20 new illnesses and diseases, okay? Like kidney dialysis, and ALS is one of those 20.
right, you
Okay.
forego the waiting
Right,
period.
you can forego the waiting period, right, right. So Juan should really get somebody to help him apply for Social Security ASAP,
Yeah, it's called the ALS Disability Insurance Access Act of 2019.
right?
One, make an appointment with your closest Social Security office.
Yes, I will. Thank you.
Ask them to go over that with you. And you should take a letter of diagnosis with you too, if you don't have that. Either get hold of the nurse at clinic, or if you just want to call me, I'll connect you with her.
Okay.
Okay,
sure.
one other thing I'd like to say is you say you own your business, but you're not actively participating in it because you're not able to right now because your health doesn't allow that. Do you draw a paycheck from that business?
I did it until the last 3 months. I haven't done any payment. Well, I had to survive. I haven't worked, but I got a payment like if I was working.
Well, you should have an account. You have an accountant, Juan?
Yes.
Okay, I would have this conversation with my accountant. Being the business owner, there is a way for you to get the profits from the business into your pocket without having them defined as wages,
Right.
all right? The secret is the money you're taking out of the business, if it's coming out in the form of a payroll check every week, now you're still working. Now you might not be eligible for Social Security. But if you're taking it out as the owner and they're coming out as profits of your business and not as wages, then it should not impact your application for Social Security disability.
You can take it out as an owner's draw.
Owner's
As
job. Okay.
wages.
Yeah,
My
Think
account
W2.
already kind of mentioned that one too. I wasn't sure, but yes, I'm gonna talk to her again and see, how can I
Think
withdraw money.
W2. Yeah, think W2, the tax form you get every single year for salaries, W2. if your business, your rental business is not creating a W-2, if you're just taking owner's draws, just distributions off of profits, that does not count. What Drew's talking about, the point she's trying to make is if the business is generating a W-2, that's a wage, right? In all likelihood, if it's one rental property, it's not filed as a separate company, you're basically just scraping off profits. It's an owner's draw. That is not a wage.
Okay. All right, thank you.
I have a question relating to that too. So Paul owns his own business, has not had a paycheck, has not paid himself, no wages, does not generate a W-2. Is there still a maximum amount that you can be getting out of the business before you would qualify?
For Social Security disability,
Yes.
my belief is the answer to that question is no.
Okay.
There's no wages.
Yeah, no wages, as
No
long
wages.
as it's not generating a W-2 or a 1099.
Because then you owe money to the government in
Right.
taxes.
If he gets a 1099 as owner's equity, that's still not wages, and that allows, like one, it allows him to take money out of his business and not impact his qualifications for Social Security.
He says dividends and distributions.
Nope, not, it should not impact his ability to collect Social Security.
Okay, thank you.
Might need another Q&A.
Well, that was a good discussion. We don't have much time left, but I believe someone might have a topic, a different topic they want to talk about if we're done with this. Miss Maggie, did you have something else you wanted to share?
Well, it's kind of related, but our internist, my medical internist, told us last month that she highly advised people who do not want to be resuscitated to have a DNR bracelet that they wear. And I just think this is kind of related, but not really. So I just wanted to throw that out there. And I did, for the last year and a half, didn't think I needed a DNR bracelet. But now I'm glad I have one.
You want to
The
explain that?
example that was given to us was if I fell or if there was a caregiver in the house that was not my husband, they might call 911 for a medical emergency, and that ambulance and EMT group has to take me to the hospital. But if you're wearing a DNR bracelet, you're protected from that trip to the hospital. The other time it was explained to me was if you fall, say in a restaurant or Mayfair Mall, or you have a heart attack or a stroke, EMS people that are called have to take you to a medical facility. Unless you have a DNR bracelet on.
Right, and you also have to have the form, the paperwork filled out and available for them to, have it handy. If you're at home, put it on the refrigerator or whatever. But
It has
we
to
have
be, Mary, it has to be the state issued DNR bracelet too. It can't be you go and have a metal bracelet engraved saying you want to be, it has to be state issued.
Right, so right, you have to have the doctor fill out the do not resuscitate form, get all those signatures. And as long as you have the plastic one on, that a clinic that was provided, that would be fine, but most people do want to purchase a metal one, it's a little sturdier. And then that's from a company called Slippery
Zippy.
J or something strange, yeah, and that's the only
It's
company
called
in the-
Zippy. But Mary, I have to tell you that plastic one was completely water ruined within 3 days.
Wow.
It only took one shower, maybe two, and it was useless. But the form was filled out the same day we were at clinic, and within 2 weeks, I have a metal bracelet.
Good. So, a lot of information. I hope it was helpful. Thank you so much, you guys.
Would you have
Thank you.
your guests fill out the form at the end of, they should be able to do it electronically.
We'll send out the deck, and at the end there is the last
The
page
deck, you mean the
is-
PowerPoint?
Yeah.
Oh, yeah.
And the last page is like
I'll get you the survey.
a survey for you guys to complete.
We want to know how we could do better.
Should I-
No, yeah,